Central bank rate, or refinance rate, can be viewed as the cost banks incur to borrow from the central bank. It directly affects the borrowing cost of businesses and households. Central banks can stimulate economic activities or slow down overheated economies by cutting or rising interest rates. Since financial markets are closely linked with the real economy, whose activities they finance, any changes to interest rates can have a significant impact on financial asset prices and yields. As a consequence of the 2008-2009 financial crisis, central banks rushed to cut interest rates in order to avoid an economic depression. For example, the Bank of England bank rate plummeted to 0.5% in 2009 from a 4% level at the beginning of 2008. In a low interest rate environment, individuals and businesses are encouraged to borrow, for example, by taking on a mortgage or financing a new investment project. It attracts money to flow into financial markets and tends to boost asset prices. For example, the FTSE 100 index of UK's largest companies climbed up to 7,000 points in March 2015 for the first time, near doubling in value since the Bank of England cut interest rates to a historic low level in 2009. On the other hand, higher interest rates mean borrowing money becomes more expensive. It generally provides incentives for individuals to save more and consume less, and businesses to slow down investment activities. Investors who save money in banks can earn a high interest rate with near zero risk. Risky assets become less attractive. As a consequence, investors observe a drop in asset prices. But this relationship does not always hold. Central banks raise interest rates when the economy heats up, which in turn might be driven by a promising economic outlook. A better economic outlook often also translates into higher profitability expectations, which then could support equity prices.